Good afternoon, everyone, and welcome to this webinar, which is the latest in the series of thought leadership discussions hosted by Suade, the provider of regulatory and risk reporting solutions to the banking and finance sector. Today, we'll attempt to navigate CRR III and provide a global perspective to Basel III implementation and financial stability. Our objectives will be twofold. First, to provide a succinct understanding of CRR III implementation, its core objectives, and specific regulatory changes the initiative brings about. And secondly, to highlight the EU's timeline in comparison with the United States and the UK. So those of you in the audience representing banks cutting across multiple jurisdictions, this will very much sit within your sphere of interest. That being said, we'll make reference to and comparisons with the challenges faced by UK-centric institutions as well. Basel III, of course, refers to the set of international banking regulations that establish minimum requirements for banks' capital, liquidity, and stress testing, which was developed by the Basel Committee on Bank Supervision in response to the financial crisis of 2008. The Pillar 3 framework of the Capital Requirements Regulation is a series of public disclosure requirements designed to provide market participants with the necessary information and data to assess a bank's risk profile and financial health. Wrestling with these topics and objectives this afternoon, we have two panelists with specific backgrounds and experience relating to regulatory compliance. They are also both familiar with the translation of regulatory guidelines into the required systems and controls necessary for a financial institution to conform to its reporting mandate. Our industry specialist and first panelist is Vincent Barich. Vincent brings a wealth of regulatory policy knowledge with him from both his work as a supervisor and implementation of capital and liquidity requirements for banks such as RBS. As head of regulatory policy for SMBC Europe, Middle East and Africa, Vincent has been closely involved in the implementation of both CRR II and CRR III in the EU and Basel 3.1 in the UK. Vincent trained as an economist. And alongside Vincent, we have Charlie Korteman, who, as technical solutions lead at Suade, brings over 15 years of expertise in the financial sector. He has dedicated his career to bridging the regulatory gap by leveraging modern technology. This enables financial institutions to interpret and fulfill their regulatory obligations. His experience spans across consulting firms and financial institutions, where he has consistently driven innovation to streamline compliance processes and enhance regulatory understanding. Today's webinar is designed to be an interactive session between audience and panelists, so we therefore welcome any questions you may wish to submit via the chat option on the Zoom application. All such questions are anonymous, and we'll do our best to include as many as we can towards the end of the session. We shall also have a multiple choice open forum question to everyone listening in during the course of the discussion. So do look out for that one and please respond, as it'll provide us with useful data for one of the discussion topics. Okay, let's start with an overview of the goals and objectives of these initiatives and drawing some guidelines as to what we mean when we refer to Basel III and CRR III in the context of countries and jurisdictions. Basel III is, of course, intended to increase worldwide financial stability, with particular focus across internationally active banks by establishing a global consistency. Much of it's already enforced, so what we're going to be doing today is concentrate on those elements that have not yet been implemented. And in connection to the terminology, we'll be employing today, Vincent, what we will use CRR III to refer to the EU implementation, and Basel 3.1 for the UK implementation. That's correct, is it not?
Absolutely. Good afternoon, everyone. So, yeah, it is worth distinguishing between CRD VI, which really relates to EU internal market issues, and that part of the legislation is not related to Basel III. So we'll ignore that for the time being here. Other topics there are ESG, for example, or third country branches. They're really outside scope for this webinar. Then we have the CRR III regulation, which really is the transposition of the final elements of Basel III, covering credit-related items, market risk, output floor, operational risk, etc. So in the UK, we'll use the term Basel 3.1, partly because that's what the PRA is using. And they are using it to also bring out that this is not just about implementing Basel in the UK, it's also to finally delink the UK rules from the EU rules. So it's part of getting Brexit done, really, is a substream here. As you implied, David, the objectives of the Basel Committee are really to ensure that there is no competitive race to the bottom regarding the supervision of banks.
Right.
That really started with Basel III. Actually, you could say it started with Basel II, but that came far too late for the 2007-8 crisis. So most elements of Basel III have, of course, been implemented already: liquidity risk, leverage, resolution requirements, etc. But now we're looking at the last elements: market risk, credit risk, output floor, etc., CVA, so a long list of that.
Vincent, I mean, you've been with SMBC for some years. Can you give us some context regarding the challenges faced by a multi-jurisdictional bank when confronted with the directives that you've just been describing?
Yes, very, very happy to do so. So first, for those unfamiliar with SMBC, we're a Japanese-based global systemically important bank and are one of the so-called mega banks in Japan. Size-wise, probably fit somewhere in the 10 to 15, between 10th or 15th largest bank in the world, depending on FX rates at each moment. So the Sumitomo Mitsui Financial Group, which SMBC is part of, has an international footprint across all major jurisdictions. So UK, EU, US, and Hong Kong, for example. And internationally, we focus on corporate banking and investment banking in particular. In Japan, obviously, we have a very big retail business as well. So I work in what we call the Europe, Middle East, and African region. And our challenge is really to implement across the EU and UK requirements. So we have subsidiaries, based one in London in particular, and one in Frankfurt, which have different rules, so CRR III and Basel 3.1 to apply. But at the same time, from a group perspective, we still need to apply the Japanese requirements. So that really is the challenge we're facing. How can we implement something at a local level that takes account of both divergences between the EU and the UK, but also to the global requirements or the requirements imposed globally on the whole of SMBC.
Right. So not so much the question of what does Basel III mean to the bank, but more what does Basel III mean to me in relation to my division and my jurisdiction within the bank. I mean, that's been a recurring topic and theme on a number of webinars and roundtables that I've been involved in as far as this particular subject is concerned. I mean, Charlie, let me bring you in on this one. I mean, based on the experiences you've had working with a sort of range of banking and financial institutions, how do the challenges described by Vincent differ from those of non-Japanese banks or UK entities, for example?
Well, there's always, and good afternoon, everyone. There's always a bit of overlap here. I mean, Vincent's talking a little bit about differences in interpretation, differences in pace of implementation there. And actually, I think the sort of two real kind of key things that people need to understand for this is firstly around data and harmonization of data. This is probably a bit more pertinent for some multi-jurisdictional banks, where if you have a robust data framework where you're capturing this data at a granular level, actually how that's then being processed in each of the individual jurisdictions doesn't matter a huge amount. And you can do that in a number of different ways. And we could go off on a whole separate webinar talking about data classification and how that's all captured and what that looks like. But the way that we do it and the way that we find works particularly for our multi-jurisdictional clients is looking at legal definitions as the way to do this. And we found that actually that generally sorts out a lot of the discrepancies that exist between that. And a lot of the discrepancies, again, exist at that kind of calculation level or how a certain product is treated in certain jurisdictions rather than actually how you're kind of capturing that data initially.
So really it's more a sort of data-centric challenge rather than something specific to jurisdictions or divisions within the bank. Is that fair?
Exactly. And I'd say the other real kind of key challenge that I see when I'm speaking to a lot of people is just resourcing and just making sure that they've got appropriate resources there at the appropriate time. I mean, I think to the UK, where I think it's fair to say that it's been a bit slower than people expected, with the election coming a bit earlier and a bit more kind of uncertainty in the regime with things like SDDT coming in, and the divergence from the kind of EU process means that people have, I think, been a bit hesitant to start projects at times. And do you want to resource up really heavily initially for those resources to potentially sit there and do nothing? Or do you want to take resources away from other projects that are happening in the bank? And I'm thinking more particularly kind of your kind of medium banks here rather than your kind of tier ones or even small banks where, you know, it's, do I want to spend my resource on this regulatory sort of output, or do I want to do some other form of digital transformation within the bank?
Cool. Thanks very much. I mean, anything to add to that, Vincent, from an SMBC angle? From the, I know that you're on the compliance side rather than on the project side, but I guess this must have a bit of a sort of knock-on effect as far as your world is concerned as well.
It does. Actually, I was going to say something slightly different, and that is, I liked your point, Charlie, about mentioning the SDDT, or, well, single strong and robust framework, because it does bring out that Basel is really only designed for internationally active banks. And we often tend to forget that. So the US, for example, has always just taken that into account, and only, you know, maybe 10 or 30 largest banks in the US are under Basel. None of the others are. And it's a really positive step from my perspective for the UK to recognize that difference on that, and what banks really need to do to manage them well from a risk management perspective. And it's noteworthy that even in the EU, people are now starting to think, do we really need to implement all this Basel stuff to every little bank? And the one thing that maybe is forgotten in the Basel III sphere quite often is that it's all about risk management. And risk management really needs to adapt to it. And I think in many banks, the data issues, because they're clear, they're obvious, come to the forefront. And banks really need to ensure that the risk management aspects, consequences of that aren't forgotten, because that is actually what is important for financial stability. It's the risk management, not any of the data we provide.
Yeah. And I mean, you can almost, I like that you brought up the US point, because actually the US has done it well in certain respects, but it's probably been a bit too lax. I mean, you look at Silicon Valley as the example from a couple of years ago now, where actually if they were maybe regulated a little bit more carefully as more of a that under the Basel III, then some of those issues might not have arisen. But yeah, I mean, how appropriate is the Basel III framework for, you know, a Landesbank in Germany, for example?
And it's exactly those sort of questions that Rachel Reeves mentioned in her speech last week at the Mansion House.
We're going off on a tangent, David. Sorry.
No, that's right. This is the nature of the exercise and the objective. So don't worry. Let's just sort of rein things in a little bit. I'd like to actually sort of drill down a bit on those sort of timelines of implementation that you both referred to across various jurisdictions in more detail. So Vincent, can you sort of summarize for us the appetite to implement the directives shown by the different regulators in the different regions that we're trying to cover off here?
Yeah, so In Japan, we have already implemented Basel III, at least for the mega banks like SMBC. So implementation date was the end of March, so 31st of March, which effectively means that for the whole of the financial year 23-24, Japanese mega banks had already been on Basel. Other Japanese banks only start at March 2020, well, 25. In contrast, CRR III in the EU is due to be effective by January 25, so just a few weeks. That is, of course, with the exception of FRTB, which has been delayed till at least January 2026. In the UK, because of delays to the response, to the consultation response, the implementation date is 2026. And then we have the US. I think it's fair to say that implementation timelines are very uncertain. Rumors now almost suggest that nothing will be implemented before 2028. We'll have to see, but that's one of the bigger complications in terms of the US. And it's probably worth reminding everyone that there are a number of other jurisdictions, Hong Kong, China, Australia, etc., which also implement, either have already implemented or will implement in 2025, independently of what the US has done.
And Charlie, I mean, can you throw some light and perhaps sort of describe some of the challenges that arise as a result of this sort of multi-speed approach to compliance, and sort of contrast that perhaps with some of the other key concerns that banks have and projects that they run in parallel, not least of which sort of enterprise-wide tech infrastructure strategies and so forth, consolidation projects and the like. I mean, here I'm thinking about sort of project management challenges, data concerns, strategic questions, various speeds, FRTB being delayed further on down the track. How does that sort of measure up with sort of banks' technical day-to-day infrastructure concerns?
Yeah, I mean, if we look at FRTB as an example of kind of some of the challenges here, FRTB, we were talking about FRTB a couple of years into my career as being something that was going to happen in 2015.
I remember that.
And then 10 years later, it's still not here. So how do you staff and resource a project like that, really? Because it's well delayed, and then, okay, we need to get that expertise in, we need to push it forward. But actually, if you don't know when it's going to happen, or it's going to be happening across multiple jurisdictions at different times, how do you retain those resources within the bank of how to do FRTB? And it can be, actually maybe as a multi-jurisdictional bank, if you can run it well, you've got an advantage here in terms of implementing this, because it might be that we're going to have a team that implements this first in Canada, and then actually we're going to use that Canadian team and the learnings that we learned from that to do that in Japan, and then the Japanese guys can train the UK and the EU guys, and kind of cascade that knowledge of that implementation and how it's worked throughout those kind of various teams within the bank. Or you can develop a sort of almost a center of expertise there. But it doesn't necessarily work like that, particularly in big complicated organizations where that kind of cross-jurisdictional, cross-team collaboration is difficult, purely sometimes on a practical basis, in terms of how practical is it for the guys in Canada to work with the guys in Japan with that kind of time difference. And again, it's, well, actually, do you really want to spend those guys in Canada pushing some of those things forward, or do you want to push them onto the next project that they've got to do? Because you've got some other directive from the central bank there that you've got to comply with, or there's the new aspect of compliance coming down, and really trying to do that would be great, but I don't know how practical it is. Maybe Vincent, you can comment on some of the ways that is, if that's happened at SMBC, for example. And again, it's again, I'm going to bang on about data because it's my favorite thing. About, okay, yeah, you might be able to source this data for one jurisdiction, but actually can you source it across all your source systems? And if you're going to need to do that in head office in Japan, for example, does the UK need to be ready for that Japanese implementation? Does it need to just send them a trade and they'll work out the specific FRTB aspects of it? Or does the UK need to implement this ahead of time because it needs to comply with head office? And actually, if it's the other way around and you're a US head office, are you left out in the wind a little bit with some of the UK or EU implementations coming in beforehand? So it's these kind of like practical comments that often we see as the real concerns, particularly from people that we're talking to, rather than necessarily interpreting the regulation a lot of the time.
Thanks, Charlie. What I'd like to do now is focus a little on credit risk and provide an overview of changes to the standardized and internal ratings-based approaches, which I know is a pretty hot topic as far as this whole sort of conversation piece is concerned. I think everyone's aware of the new risk sensitivity and updated internal modeling requirements. But Vincent, let's look at these in turn and perhaps underline the contrasts and divergence between UK and EU approaches. Perhaps we can start with investment grade risk weights. What do you make of the UK's divergence for unrated corporates, for example?
Yeah, maybe just to give a bit of background. So normally exposures to unrated corporates in Basel are given 100% risk weighting, but the PRA is proposing to allow firms a more risk-sensitive approach once they've given permission. So it's on application. Under that approach, banks would have to make an internal assessment and categorize their exposures into either investment grades with a 65% risk weighting and those that are not investment grade at a 135% risk weighting. So the argument that the PRA had for that is that the two would average out at 100%. So they are in line with Basel still fundamentally. The big question is that actually correct? What impacts would that have on the wider economy? So that's one difference, because certainly the EU hasn't implemented anything like that. Another divergence is the infrastructure supporting factor. That was a reduction to capital requirement to help investment in growth via infrastructure in the EU on that. But it was that really has a political objective and is prudentially, so I mean, it's not justified from a supervisory angle. So that is the justification why the PRA is not proposing to continue. What we have are the consequences that actually EU banks can offer terms a lot more advantageous on certain project finance deals than some of the UK banks. The other difference is that the PRA doesn't actually want to increase capital, even though it's removing this supporting factor. Therefore, it proposes to sort of net any increases off at a Pillar 1, at a Pillar 2 level, which we will have to see how that is due to work in practice, and there will be further consultations next year from the PRA on that topic. Other big Basel changes, well, the introduction of specialized lending and the standardized approach and additional real estate requirements. The real estate seems to be one of the key issues in the UK implementation, particularly for banks, the smaller banks on the retail side. The PRA has introduced many UK-specific elements here, and that creates further divergence to some extent. But even it raises questions for pure UK implementation.
And the treatment of off-balance sheet items as well?
Yes, that's another one where there are quite a big differences. So in the EU, well, let me start off with Basel. So Basel has introduced two new credit conversion factors, 40% and 10%, to convert off-balance sheet items into capital requirements. The EU has defined commitments in such a way, or it requires capital for commitments as soon as a customer has been informed of the proposal of the commitment, whereas in the UK, it's much more once the customer has accepted the offer. Now, that timing difference brings particularly data challenges to firms, and something that Charlie mentioned, that how do you deal with different data attributes that are required across different jurisdictions to actually achieve the same calculation? That has a big impact, for example, on syndications. That. Yeah, let me leave that here for the time being. I didn't focus on any of the IRB issues, just to briefly mention some. Disappearance of the sovereign models, for example, the equity models, wider use of FIRB, that means LGD has been given by regulators, the quasi-sovereign separate exposure class in the EU that doesn't exist in the UK. So there are quite a few challenges specific to IRB.
Right. Thank you. Let's move to our next topic, and I'd like to now introduce a sort of hardy perennial, which is output floor. And the premise of the risk-weighted assets calculated using internal models cannot fall below a given percentage of the RWAs calculated for the standardized approach. As we know, the proposal is to phase the floor in over a transitional period from 2025 to 2029 to reduce the impact on regulatory capital requirements. Adjustments will also be made to the leverage buffer requirements for GSIBs. Before we kick this one off for discussion, I'd like to introduce a question to the audience, so we can perhaps get a measure for everyone's view on the timings of this directive. And hopefully, if Ethan in the background, our technical wizard, can organize things, we should have the question appear on the screen presently. Here we go. So, when do you expect the output floor to be a binding constraint? Not for the foreseeable future, 2024 to 26, 27 to 28, and 29 to 30. If everyone listening in and watching, fingers on buzzers, if you can please register your votes, we'll then analyze them. Thank you very much. By the way, guys, who hosts the University Challenge nowadays? Is it?
I've not watched since Paxman, so I don't know.
I was going to say, I mean, I dare say you're a pre-Paxman man, aren't you, Vincent? I know I am. Bamba Gascoigne.
I wouldn't know. No, I wouldn't know.
No, I was a failed attemptee to get onto University Challenge. They wouldn't have me.
I never even got asked. Okay. Ethan, when you're ready with the results, we'll take a look. Okay, that's interesting. Okay, so 27 to 28 seems to be the most popular of the options available. What's your immediate reaction to that, Vincent? Because this was a question that I think that you were quite interested in.
Yes, I think that's aligned to what my understanding is as well. But I think the second thought is the impact this has really on those banks that are to whom it applies earlier. in terms of business opportunities. Does this really create competitive advantages? How do you introduce that into pricing, for example? Those are important questions. So are we in a world where banks can start arbitraging across jurisdictions and almost undermine the whole objective of the Basel proposals by actually utilizing those differences?
And then we've got the sort of the impact across different balance sheets as well. I mean, this presumably would be different across banks, even in the same jurisdiction, yes?
Indeed, I think the output floor is a measure that's really balance sheet specific. So every bank will have different challenges from the output floor. I mean, the genesis of the output floor is really that supervisors no longer fully trust how models were implemented in banks, so need a backstop measure on that. But it also means that banks, for example, that have smaller part of their balance sheet on advanced models do actually get a benefit of those or can push further. It creates business opportunities for some elements as long as the floor is not breached on that. Other challenges this brings is, particularly in international environment, is how do you bring together from a corporate finance perspective your hurdle rates for specific transactions in line with the output floor, because the output floor is a portfolio measure that's conceptually not really designed to be brought into transaction by transaction specific pricing. Could imagine a scenario, for example, where a transaction is profitable under Japanese rules, but then it might not be profitable under UK rules. Now, for the UK subsidiary, what does that mean? Is it still profitable at a head office level, even though actually the capital charge at the local level is relatively high? So those are dynamics that actually all internationally active banks to some extent face.
And just to kind of jump in here as well, I think this is the main problem that I see with the output floor, and I do think that it's probably going to get pushed back again. Just a feeling, there's no like understanding behind that to try and effectively align implementations a bit more holistically across jurisdictions with regulators, because I don't think any regulator wants to see their own jurisdiction become uncompetitive. And having a more aligned approach here, I think, would help reduce some of that potential for arbitrage, I should say, that exists. And I mean, just looking at this from other institutions' perspective, it's like, wow, how effective do models become at that particular point in time? It's, if you're spending millions of pounds, millions of dollars, millions of yen, whatever currency it's in, maintaining these models internally, and actually the capital benefit isn't that great, and you're still having to do that standardized calculation anyway, you suddenly decide to kind of push certain products into more specialized jurisdictions? And if that arbitrage potentially exists, is it like, do you effectively have almost kind of centers where actually this type of trading is profitable in Japan but not really elsewhere, or this type of trading is profitable in the UK but not in the EU? And does that lead to more specialization in particular types of products in certain financial centers based on some of those local implementations? I wouldn't say that's a good thing personally.
Any closing thoughts on that, Vincent?
Yeah, I think that's very true. I think particularly given with that we don't know where the US is going to take that, and almost one could say there is no implementation date at all. So actually, will we be seeing even more arbitrage opportunities across the globe, and therefore a reduction in financial stability? How much is that something to worry about? Can we deal with something like 2007, 2008 again on that? So that's the wider consequences of exactly that point.
Thanks very much. I mean, we're almost at a close, so let me just have a look to see any questions that have come through from the audience. We've got one here, which is, Vincent, I guess this is one for you. What do you think will be the impact of the UK's risk-sensitive approach for banks?
That's an interesting one, because it links back to just the previous point that Charlie mentioned. So one can absolutely see sense in something like this new risk-sensitive approach for banks. So that's the unrated corporate elements here, which I referred to earlier. But again, at a UK level, it makes sense. But the way it's written, it applies, it gives a benefit to UK-based groups, financial groups, banks, also for business overseas. So let's take Standard Chartered, HSBC, or others could use that benefit to underprice Malaysian banks, for example, Australian banks. That's the sort of problems that then give rise to reduced financial stability. It absolutely helps London as a financial centre, but to me, there's always the question, at what cost in the longer run, in the longer term? And just to be fair, an additional point is, coming at it from being an economist, I'm not actually clear that it is that beneficial for the UK itself. I just accepted that for the sake of argument earlier, because this idea that it neatly boils down to 100% on average doesn't work in practice. Banks do have strategies. Some banks are more likely to have non-investment grade exposures, others more likely to be more focused on the investment grade. That means in practice, those with primarily investment grade activities in that would go for the risk sensitive approach with a 65% risk weight. The others would stay on the risk neutral 100%. So in practice, this isn't about 65 to 135. It's actually 65 to 100. So maybe that's what politicians expect from it, at the price of potential arbitrage. Those are the sort of questions this brings.
Thank you very much. So everyone, we've now reached the end of our time and of the webinar, which I guess sort of underlines the variable nature of Basel III, CRR III, according to structure of organization, as well as the differences across both individual business disciplines and the jurisdictions over which a bank may happen to operate. It only remains for me to thank you for all attending. And of course, special thanks to our two panelists, Vincent and Charlie, for their contributions to this afternoon's discussion. Do tune in to our continuing series of Suade webinars, and I hope the event was informative and instructive. Very good afternoon to you all, and goodbye. Thank you very much.
Thank you.
Cheers.
Bye-bye.